Hi, everyone. I'm Ed Barrie. I'm the Chief Product Officer at Treasury 4, and I'm joined today by Amol Dhargalkar, who is Chairman and Global Head of Corporates at Chatham Financial. Amol, thanks for taking time out to join me today and having a little bit of a discussion on the state of the markets. We'd love to just get your perspective on where things are at in the interest rate and foreign exchange markets. Get your perspective. It wouldn't be a call without you, without getting perspective on the markets and really what are you and Chatham seeing in the kind of near term and medium term?
Well, I think first of all, thank you for having me on here, Ed. Always a pleasure to connect with you and talk about all these types of fun topics that we're about to dive into. I think I'll start by saying I do not envy Chairman Powell and the job that the Fed has. It might be the toughest job that the Fed has had in not just recent history, but in its real, in its tenure. There are, of course, just from a macroeconomic standpoint, inflation is still running a little bit higher than target. But we're starting to see some cracks in the labor market and in the job market. So we'll see how that turns out over the next few weeks and months as more data comes in. All of that is happening at the same time as probably all of our colleagues and listeners know that there is been a significant amount of attacks on the Fed by the current administration. To some degree, they have a point in saying like, hey, rates should be lower. Back to my earlier comment on the labor force, they are looking to continue to bolster the economy. On the other hand, it's certainly not the standard decorum for an administration to take such a heavy-handed approach with the Fed. And we'll see, what, if any, impact that has, not just on near-term decisions by the Fed, but also long-term implications for the U.S. and for investors in the U.S. Earlier this year, we had a lot of talk of sell America trade, if you will, quote unquote. I think there's relatively little evidence that there's a run away from, the American market for investors. But, on the margins, we certainly continue to hear, some interesting chatter from investors that might position their portfolio more, towards Europe or other places relative to what they might have done otherwise, as a way of mitigating some of the risk of, the U.S. Maybe falling victim to some extreme politicization of its central bank. So anyway, a lot to chew on, but those are some big themes, and we can dive into any of them. But those are some big themes that that are being talked about, and really, everyone is looking for interest rates to go lower, but they want them, I'd say most professional investors and market participants want them to go lower for the right reasons, so to speak, rather than for just any reason.
Well, that's certainly insightful, Amol. And I think the word, probably the word of the year, maybe the word of the decade is unprecedented. There's been a lot of unprecedented activity, a lot of things that have been happening that we haven't, historically seen. Maybe discussions that were happening, behind closed doors at the, kind of the executive level of the government and the Federal Reserve, now really spilling out into the open for good or bad. It's just I think the kind of where we're at maybe as in the current climate here, but unprecedented nonetheless. Maybe give us some insight in terms of the customers that you work with, ranging from corporate treasuries to commercial real estate to private equity and to financial institutions. What are the questions that those treasurers and CFOs are asking you and the team at Chatham, and how do they differ, or how are they the same during those discussions?
Yeah, it's there are definitely, to your point, Ed, some common themes across all, but even within them, even within each of those industries, there are some distinct and unique conversations that are being had. So So let's start with the common themes. The common themes are, particularly as it relates to interest rates, what we were talking about earlier. Where are they headed, and how does that impact our business? If you're a bank, that looks in a financial institution that looks very different than if you're a financial sponsor that's making, investments in portfolio companies, which is very different than a manufacturing company or a real estate investor. But that common theme is very much there. And I would say as I mentioned earlier, there's a universal degree of agreement that people want rates to go lower. There's some debate on how much lower they should be and how quickly they should go lower. But I haven't heard anyone calling for higher rates. Although I think some Fed governors recently came out and said, well, there's an argument for higher rates, but I haven't heard too many people calling for that yet. Beyond that, you really start to get into very specific, concerns by industry. So, let's take a multinational, company of some sort. Certainly, one of the big themes they've been focused on is dollar weakness and what does that mean for them, along with the uncertainty in trade policy and how should they be navigating that uncertainty, i.e., if tariffs are going to remain elevated and on any given day, the tariffs may be legal or illegal, or they may be lower or higher. But I think that is the challenge that a lot of multinationals face: is how do we navigate this market? Go to a private equity investor. They, of course, have to think about that in the context of their investments that they're making. But for treasury within private equity, it's a bit unique because, for private equity sponsors, treasury is a little bit different because they're not really running the capital markets activities of all their portfolio companies. They are, trying to run an efficient fund, an efficient, GP or general partnership structure from a capital standpoint. And there are some tools that we've seen that are being deployed from a capital market standpoint that are very popular with funds, especially fund finance and leverage within these vehicles. Real estate is among, if not the most leveraged asset class that retail or institutional investors have access to, and for them, put aside some of the COVID concerns around sub classes like office and others. There's some real concern over when will we start to get velocity and transactions back into the real estate market? And a lot of that is tied to, certainly to interest rates, but a lot is also tied to behavior. So, if you're in Class B or C suburban office, that looks very different than, Class A office in New York City, for example, where occupancy rates continue to just go up. And then for financial institutions, they have a very unique challenge of navigating this oddly shaped yield curve. It's not, the typical yield curve, as you know, Ed, is an upward sloping yield curve, and banks are built, and the entire banking industry is built on this concept of, borrow short cheap and lend long at higher rates and manage that interest rate and duration mismatch a little bit. But right now we continue to have, at times we've had U-shaped curves, we've had inverted curves, we've had normal shaped curves, depending on where you are on the curve. That's a real challenge for banks looking to manage their balance sheets. So again, every industry has a slightly different set of challenges, but there are some common threads here.
Well, I think that's one of the great things about Chatham and what you do in the industries you cover. You get to see kind of across that spectrum and the unique needs of each of those industries and how they're managing financial risk, interest rate, FX, commodity, and so forth. Maybe switching gears a little bit, I think it would be hard to have a conversation today without raising our two favorite letters, AI. I'm just curious, like what type of conversations are you having with your customers, your partners, when it comes to artificial intelligence, and how are people thinking about it? Are you seeing any tangible use of AI? What are people asking for? Saying, what, can we apply AI into these areas for better understanding? Just love to get your perspective on what you're hearing.
Yeah, I mean, it's interesting, and I'd love to hear from, Ed, you too, some of the use cases you're hearing and seeing from people. But let's talk about some of the perennial challenges that corporate treasury has. Number one, two, and three, and I think you'll confirm this, is cash forecasting. Right, at its core, one of the jobs of the treasurer and the treasury team is to have a handle on where the cash is and the liquidity of the firm. That has always been a challenge. It's not clear to me that AI is the answer to all life's problems there, but everyone that we've talked to is trying to experiment at a minimum and productionalize at a maximum some AI use case around cash forecasting or something along those lines. And that is, I would say, if it's number one, two, and three as a priority, it probably is one, two, and three in terms of where we've seen AI as deployed within corporate treasury. Um, I'd be curious if you're seeing something similar or different. And
Yeah, I think we're seeing the same. I mean, we can't have a discussion today. It's very hard to have a discussion where the topic of AI isn't coming up. But certainly the top use cases, the top perennial problem in Treasury across the board is cash flow forecasting, and how can you leverage more data, the right definitions on the data, and then leverage AI to drive a more precision-based cash flow forecast and interpret or have understanding of what's driving that forecast. And so that's a big focus area here at Treasury 4, is how do we get more data into the system, into the platform that provides deeper insights and understanding of future cash flows. Number two is how can we leverage AI in suggestive, what we call transaction categorization. And so for those that aren't familiar with transaction categorization, it's putting a business or a treasury definition around every single inflow or outflow, while aligning that to the statement of cash flows. Because at the end of the day, every transaction has to be operating, financing, or investing. And I think that's where a lot of people kind of miss the mark on cash forecasting, is that's really what you're trying to drive for. And that's the CFO and others are really interested in operating and free cash flow. And then in terms of suggestive transaction categorization, that follows then with transaction reconciliation. Did what I expect to occur actually occur, and do I have any exceptions? And so leveraging AI in this high transaction, cash transaction categorization, reconciliation, and then leveraging AI to drive a more prescriptive forecast. Those are the key use cases that we see and discuss all the time. And then after that, that's kind of dependent on each of the customer or who we're talking to. And I think some of the opportunities longer term are looking at some of the quote unquote rule books out there, like tax repatriation and cross-border payments, and saying, okay, now can we take the cash flow and apply it to the rule book so that we can then understand what's the impact of moving cash around cross-border and the different types of movement to support that, whether it's an intercompany loan, intercompany dividend, return of capital, and so forth. And so I think that's a longer term where we'll see maybe some application of AI into those interpretations there.